Ladies and gentlemen, good day and welcome to Q3 FY24 earnings conference call of South Indian Bank, hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chintan Shah from ICICI Securities. Thank you, and over to you.
Thank you, Yashashree. Good evening, everyone, and welcome to the Q3 FY24 earnings conference call for South Indian Bank. We have with us from the management, Mr. P.R. Seshadri, Managing Director and CEO, along with other senior executives from the management team. So without further delay, I would now like to hand over the floor to the MD, sir. Thank you, and over to you, sir.
Thank you very much, Chintan. Good evening to all of you, and thank you for joining us for the South Indian Bank Limited Q3 FY24 earnings conference call. I'm here together with my colleagues, Mr. Thomas Joseph, Mr. Anto George, Mr. Sanchay Sinha, Ms. Chitra, and others. Let me start with the key highlights of the financial performance for the quarter ended December 2023. Total business grew by 10% to reach 1,76,641 crores. Total deposits grew by 9% to hit 99,155 crores, just a touch short of 100,000 crores. Gross advances grew by 11% to hit 77,686 crores. Net profit for the quarter grew by 196% year-on-year to hit 305 crores. CASA amount increased by 3% year-on-year to 31,529 crores. Net interest margin for the quarter stood at 3.19%. Provision coverage ratio, excluding write-off, improved by 688 basis points year-on-year to reach 67.08%. And PCR, including technical write-off, improved to a touch under 78%. Gross NPA reduced by 74 basis points from 5.48% to 4.74% on a year-on-year basis. Net NPA reduced by 65 basis points from 2.26% to 1.61%. Improvement on ROA to 1.07%. So this quarter, a return on assets came in at 1.07%. And given the structure of our balance sheet, that resulted in a return on equity of 16.38% against 6.42% for the same quarter in the prior year. Recovery and upgradation in NPA accounts stood at 377 crores. CRAR at the end of the quarter stood at 15.6%, of which Tier 1 stands at 13.37%. We continue to grow our gold loan business. It now stands at approximately 15,369 crores. Personal loan, another segment where we are a late entrant and we have a small book, but the book continues to grow. We launched our pre-approved personal loan business in December 2021. As of December 2023, our book stood at approximately 2,186 crores. Credit card is another area of some growth. This was launched in 2022. As at December 2023, we had issued 3,77,134 credit cards with monthly average spends of approximately 22,780 rupees per card. The total book as on December 2023 was 1,427 crores. On the liability side, core deposits grew 7% to 95,088 crores. NRI deposits continued to grow and now stand at 29,236 crores. Investment, approximately our total investment books stood at 26,654 crores, of which HTM was 22,374 crores, and AFS and HFT the rest. Fresh slippages for the quarter was 267 crores, which is amongst the lowest numbers that we've had in recent times. And it is in line with the guidance that my predecessor had given you. The overall restructured book stands at 894 crores, and the bank holds standard asset provisions, including standard restructured and FITL loans of the extent of 451 crores. Net interest income for the quarter was 819 crores. Core fee income increased 19% year-on-year to 178 crores. Treasury profits for the quarter was 113 crores. You would have seen from the investor presentation that has already been uploaded that a significant portion of our growth continues to come from the corporate side. On the asset book, corporates now constitute approximately 39%. And we also have included a section that talks about the steps that we're going to take going forward to rebalance our balance sheet, improve our efficiencies, and also improve operating results for the institution. So we continue to maintain momentum in disbursements and collections. Our strategy has not fundamentally changed. We continue to focus on elements that my predecessor had focused upon with nuanced changes as to how those need to be implemented as we go forward. And the results that you see today are a reflection of the fact that the underlying basis on which the strategic elements were put into place were sound, and we hope that as we continue to go forward, our outcomes will be suitably rewarding. With that, let me turn you back over to Chintan.
Should we begin with the question and answer session, sir?
Yes, please.
Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In order to ensure that the management is able to answer queries from all participants, please restrict your questions to 2 at a time. You may join back the queue for follow-up questions. We will wait for a moment while the question queue assembles. We have a first question from the line of Rakesh Kumar. Please go ahead. We have a question from the line of Parth Mehta. Please go ahead.
Sir, my one question is, how is the cost of funds panning out for us vis-a-vis competition?
I think the numbers you'll find in our investor deck. Our cost of funds continue to rise on account of the fact that our deposits are repricing. So our deposit cost of deposits is right now at 5.18%. And I think that compares favorably with some of our competitors who are Kerala-based. So we continue to be well placed on this front. As our deposits mature and as they get repriced upwards, we do have continuing cost of fund increases, as can be seen in this chart on page 16 of our investor deck, actually.
Okay. So, is there any cap that we are looking at, or it will be a moving phenomenon as we go ahead?
So you were asking me, about our peer banks and how our cost of funding was
yes.
to them. You can see that on the Federal Bank investor deck if you so desire and compare the numbers yourself, and you'll find that we compare favorably.
Favorably. Okay. And the way ahead for us? It will get better. It will keep on rising from here on. As
prediction is that it will continue to rise from now on.
Yeah. Okay. That's it. I'll join the queue. Thank you.
Thank you. We have our next question from the line of Rakesh Kumar from B&K Securities. Please go ahead.
Yeah. Am I audible, sir?
Yes.
Yes, you're audible.
Yeah. Thank you, sir. So, sir, firstly, considering the disbursement number for the 9 months and the book outstanding that we have, loan book, would like to understand what is the average maturity of the loan book that we have, sir?
We've not computed that as such. So our loan book consists of multiple parts. There is a corporate loan book, which is the largest chunk of our balance sheet, as you can see. Then there's gold loans. Gold loans are on average 6 months maturity. Then there is home loans and mortgage loans and stuff of that nature, which is a smaller chunk. And then there's MSME, which is, between overdraft and term, which have, reasonably long maturities. The area where we have very significant repayment and then dispersal again is on the corporate side, and we've not computed the average maturities at this juncture. We can make that available to you. We believe that it does, in a rising interest rate environment, it offers us some advantage in the sense that we are able to reprice our assets periodically, keeping in view the price on the liabilities end, and therefore the structure as such is not disadvantageous to us under these circumstances.
Understood.
Yeah.
Mr. Kumar, you're sounding muffled. Please use your handset mode. No, we can't hear you.
Is it better now?
Yes, please go ahead.
So, sir, another question was this pertaining to the notes of accounts. There is a mention of provision for around 3.1 billion, around 300 crore for security receipts. So, if you can elaborate on that, what is the change that we have found in the RBI guideline pertaining to the security receipts?
I think you are referring to an event that took place in the Q3 of the prior year, wherein certain provisions were made to the assets that were held by us in the form of security receipts, and they were written down to the extent of that amount. And this is not an event that has taken place in this quarter. This is an event that happened a year ago. The consequence of that was the fact that profits for that particular quarter were depressed. And as another consequence, the profits for this quarter compared to that quarter seem, are consequently 200% greater.
Okay, sir. Okay. And sir, this fraud account, there's a provision for the fraud in one branch.
Yes.
So what was that related to?
That is related to an event that has taken place in one of our branches, a consequence of which is that we suspect that there could be an impact to the extent of 28.6 crores or thereabouts, and that has been fully provided.
Mr. Rakesh Kumar?
Yes, sure, sir. Thank you, sir. Thank you.
Thank you. We have our next question from the line of Saransh Sethi from Summer Wealth Managers. Please go ahead.
Am I audible?
Yes.
Yes, please.
My question is about cost to income ratio. As we see it is higher compared to peers, how does management see this 1 or 2 years down the line? And what's the guidance on net interest margin for upcoming years?
So let me answer that. There are two questions, cost to income and net interest margin. On the cost to income side, as you rightly mentioned, compared to our peers, our cost to income ratio is higher. We are currently at about 61.98, which is very close to 62%. So if you see our investor deck, there are 5 areas that we as a management team are going to focus on. One is enhancing our portfolio resilience, which is basically a complicated way of saying that we want to have a more granular book. We want to improve our branch productivity. And third is cost optimization. So we are seized of it. The current high levels are on account of a few one-timers that we've had to take. So this quarter we've provided for the IBA wage settlement that happened. We were accounting for it at 15%. And in this quarter, we've had to make a difference between the 15% and 17%, which is the final settlement amount. And we estimate that is approximately 24 crores of incremental provisions were taken. So to that extent, our expenses are overstated from the normal. But having said that, our base expense ratios, even without this one-timer, is higher than our peers, and as a management team, we are looking at methods of addressing that and attacking that as we go forward. And with respect to net interest margins, our net interest margin for the quarter came in at about 3.19%, which is sequentially lower than the prior quarter. And that is on account of basis risk playing out, in the sense that our liabilities are now repricing faster than our assets, and as a consequence, squeezing our margins. To address this, there is no short-term method of addressing this very, very quickly. The only way to do that is to change the structure of our balance sheet from an assets perspective, and that we have walked you through in this strategy parts of the deck that we put out. The other thing that I want to bring to your attention is what I just mentioned. Our assets are of shorter duration. The lower yield assets, which are put out to very high quality corporates, are of very short duration. And the hope is that as interest rates rise, we'll be able to transfer some of that to our customers and consequently keep the NIM at reasonable levels. So I trust that answers your question.
Is there any guidance on this for upcoming years?
Sorry, sir, could you repeat that question?
Sir, any guidance on NIMs for upcoming years?
I hesitate to give you a guidance because we are in the process of putting together a long-term strategic plan for our institution at this point in time. All I will say is that we want to restructure our balance sheet and have higher yielding assets, larger proportion of them on the book. So from a directional standpoint, we will be working towards taking NIMs up as we go forward. We are hoping that all our analysis and work can be done reasonably quickly, and we can come back to you with a guidance reasonably quickly.
Thank you, sir. That's all from my side.
Thank you. We have a next question from the line of Prabal from Ambit. Please go ahead. Mr. Prabal?
Hello, am I audible?
Yes, please go ahead. If you can speak a bit louder, please.
Just give me a second. Is this better now?
Can you use your handset mode?
Yes, I have. Is this better now?
Yes, please go ahead.
Hi, sir. Congratulations. So my first question is just an extension of the previous participant question. How do you get in branch productivity and cost optimization? If you can explain your strategies there.
So on the branch productivity, we've done a few things. We've started, branches do two things, Prabal. One is they provide service. So customers come in, they have a query, they need something, they provide that service. The second is they sell products. So we are doing we've started, we've done a whole bunch of analytical work to figure out on average different products when they are sold to a customer, what the revenue stream is in the future. And we have discounted that back to arrive at an expected value per product. And we have started measuring, and this is something we call sales value added, and at the branch level, we have started measuring what is the value addition that is happening at the branch. So all our products that we sell out of the branch, we have this metric. So at any given point in time, we are in a position to tell how much sales has actually happened and value addition has actually happened. So that measurement metric has now been rolled out, and we are using that to also provide some form of rewards to our people at the branch. So we hope that this will make for two or three things. It will make for comparison between one branch and the other, because in the past, branches sell various products. We are an old generation private sector bank. The branches sell not only liabilities, they also sell assets. They also sell funded, non-funded products, all kinds of products they do. And comparing one branch with the other became very difficult because you had to compare them on many axes. With this, you can compare them with one number. And given that we've also started a mechanism by which our people can be rewarded on their performance, we think that will change, bring out, some amount of increased productivity at the branch level. The other thing that we've done is that we are working on our processes and our systems. So we had implemented two loan origination systems, one for our retail businesses and one for our wholesale business, not the wholesale but the MSME business. These are generic system installations which enabled us to book any type of customer for both the retail and the MSME business. We are fine-tuning these so that these become frictionless and you're in a position to actually do these loans quickly. So there's a whole work stream around that, which is an enablement work stream that enables the branches to service our customers better. So all of this is actually in the deck. I'm happy to walk you through it in greater detail at another time. But in the interest, given the fact that we have a large number of people on this call, I'm afraid I'll have to end this, at this point. But if there are other questions, I'll be able to give more clarity.
Yes. Thank you for this. Next question will be, so the MSME book has been sort of flat in last 3 quarters. So what is happening there, and how do we ramp up the book from here on?
Okay, the MSME book has been flat. In fact, it has declined marginally. It is an area of, focus for us. Again, it has two elements to it. One is we have to get our sales engines firing, and we also have to get our processes and the technology arm associated with the processes working again. The good news is the new originations in Q3 were the highest that we've had in recent times. Some of the reduction in balances that you notice are because of utilizations coming down in our overdraft account. But having said that, it's still not robust enough for growth to come. So this is an area of great focus. We are working with our teams We are trying to enhance the number of people in this business, and at the same time, we are trying to change the process so that product, process, all of that to make it more appealing in the marketplace. So this is something of a long haul. We need to work on it so that we get appropriate results as we go forward.
Okay. And just last question. So how much of our deposits will be coming from Kerala? And just a related question will be, we have improved our credit to deposit ratio in last few quarters.
62% of our deposits come from Kerala. And what was your second question? I'm sorry.
Second would be, we have improved our credit to deposit ratio in last few quarters. How is our treasury team thinking about any range that we would want to settle at? Credit to deposit ratio.
So we are currently at about 78 and change credit to deposit ratio. We would like, I think there's a few percentage points left where we can go up on the CD ratio without creating any issues on liquidity management and impacting other liquidity related matrices for the bank. It will also be profit accretive if we were to be able to do that. So from the bank's point of view, two things have to be noted. Our deposit book grew 9% year on year, and we believe that the 9% growth is predicated by the fact that on the deposit side, our pricing has been such that our landed cost of deposit are lower than our immediate peers. Should our asset side growth pick up very dramatically, we believe that we can get more deposits quite easily. And therefore, from a credit to deposit ratio point of view, we believe that we are well placed. 78% is not too high. I think even RBI is talking about between 70 to 80 and so on and so forth. 70s, early 80s, I guess, is an area of comfort for them. This is my understanding from whatever newspaper reports I've been reading. So we think that we are well placed. We think that there's space for us to grow this, and that will be P&L accretive. So at this point in time, that's where we are taking our business.
Great. Thank you so much, and all the best.
Thank you. We have our next question from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, good evening. Thanks for taking my question, and congratulations on the quarter, sir. Just two questions. One, on the capital raise, just wanted to understand, has the board taken any decision in terms of timing, quantum of the capital raise, and the route that we would through which we would like to do the fundraise?
Umang, I'm afraid on this subject, there is no information that I'm able to give you at this point in time because no decisions have been taken. And at the right juncture, we will make all this information available as we go forward.
All right. Okay. And sir, the second question is now, while we do appreciate that clearly you and your team are in the process of putting out a long-term strategic plan for the bank in place, but just want to understand that clearly we have crossed the 1% ROA mark after a fairly long period of time, right? Should we assume that regardless of the changes that you intend to bring into the bank, the trajectory, the earnings trajectory, or the trajectory of the returns ratio that we are seeing at this point of time will more or less be sustained, and then probably we see a gradual improvement, or do we see some bit of a disruption initially and then see a pullback? How should we look at it from a near to medium term perspective?
So, at this point in time, business as usual continues. So we have not changed anything very dramatically over the last 3 months. the areas of focus that my predecessor had put in place